Hi everyone, it's Jack back with another video. Today I'm going to be talking about Medical Properties Trust, which is a pretty interesting business. I've done a couple of videos on it in the past. It's about as interesting as a REIT can get, a REIT that specialises in healthcare properties, hospitals, etc. Interesting because it's down significantly in the past year and down significantly from its highs of a couple of years ago, down 37% in the past 365 days. Decently off its 52-week low of around $7 to $9.69, but way off those 52-week highs. The most interesting thing about this business is it pays a 12% dividend right now and is trading valuations that it hasn't seen for a significant period of time. I think that's interesting. I'm going to talk about a recent statement that the business made outlining the problems that it faces and how it is dealing with those and what they perceive as rumours that are unwarranted, bringing the valuation down. So I'll analyse that, analyse the valuation of this business, and analyse what I think of the company's prospects going forward. Medical Properties Trust obviously believes that these sort of healthcare property investments are very attractive investments. They believe there's a sort of moat here, scarcity of developable real estate, growth constraints on existing competitors, and high startup costs and or regulatory limits on new entrants, which are obviously not present with Medical Properties Trust. The lease termination is extremely rare, although it is going through some problems at the minute with some tenants struggling to pay their rents, which we'll talk about briefly. There's going to be generally a long-term patient demand growth as global life expectancies are on the up. That's an increasingly elderly population. There'll be more need for hospitals and healthcare locations, which companies like Medical Properties Trust will be able to benefit from. And rent expense is typically a very small portion of the tenant's net revenue, allowing for a relatively stable portfolio growth. Of course, there has been some, Medical Properties Trust would say, perfect storm events, but there has been some problems with some of the largest tenants. In the business's own words, they believe there is an unwarranted valuation disconnect in Medical Properties Trust, and I'm inclined to agree with them. Net asset value premium to discount is now around 41%, which is absolutely staggering compared to their peers of just -3%. Obviously, this is less to do with changes in the business model or execution and more to do with a couple of tenants. The largest and third largest have significant problems paying payments, which for a large part have been sorted out, and some problems which we'll address on a further page about how Medical Properties Trust goes about its business, and they've addressed these problems in full. And to me, it's now just looking like this significantly undervalued business versus its net asset value. It's essentially a business trading significantly below book value, in my opinion, and it's looking rather attractive. The scale of the valuation decline for this business is perhaps better illustrated by the net asset value discount, which is -41%. But I think to the average person, PE and price to cash flow are the language we speak, even price to book value. I think it's clear to see here that over the last, from 2017 to now, it's trading at its cheapest price to book value ever, the cheapest price to cash flow it's ever done, and price to earnings rise, which is not so important for REIT. It's still round about its 5-year average, so price to cash flow significantly below the 5-year average, price to book value half its 5-year average, far below 1, which I would consider about right for a REIT, and significantly below pretty much any time it's been in the history of this business. I think all of these combined with that net asset value discount show this is looking like a relatively attractive valuation with significant 12% dividend yield right now. And that's even after a significant rise in the stock over the course of June since this report came out from the business, which is the start of June. The stock has rose around 15% since then, which is really bullish. I think the key information in this report that has caused such bullish movement in the stock around 15% is the laying out of the allegations that are against this business and succinctly coming up with rebuttals against them by showing facts. Now, I don't necessarily agree with all these. For example, the false claim that MPT consciously overpays for real estate. This is an allegation that's been floating around for some time. I think it was a Wall Street Journal article. The facts they put out are valuations repeatedly evaluated by transactions with sophisticated investors. They had a 47% gain on the sale of real estate of 8 hospitals in a partnership with Macquarie. Completed sale of its Australia portfolio at 5.7% cap rate during a time where global markets were having significant disruption. That's fair enough. And executed or announced nearly $500 million in property asset sales to Prime. These are all well-known facts. Doesn't necessarily disprove what they have been alleged to have done, but nevertheless these are reasonably well presented facts that I completely agree with, and recently they have achieved some very good amounts of capital from the sales. Second, MPT engages in round tripping of rents. According to them, it is simply not possible to round trip funds sent directly to third parties, which seems to make sense to me. This one never really stuck in my opinion. Virtually all of the $27.5 million investment in the new hospital near Houston was directly paid to the former owner, along with contractors, architects, etc. When they acquired 11 hospitals as part of the Steward merger, paid $1.4 billion directly to an IASIS bank account. There's been a defamation lawsuit that they've published in full, and I have read the majority of that. It's a very long document, so I'm not going to wouldn't dare dream of reading the whole thing, but I completely agree with this. I thought this was by far the weakest claim. And the final claim, tenants are in a weak financial position and are unable to continue paying rents. Now, for a time, this almost couldn't be argued really that tenants were in a weak financial position. The question really is, can they continue paying their rents? Recent actions demonstrate MPT's careful leasing structure and effective portfolio management, and it's basically that they've decided to help out some of their tenants, the main one being Prospect. Expect resolution of Prospect exposure with reasonable likelihood. All Q1 23 assets are recovered. Outstanding financial outcome and validation of underwriting and master lease structuring for Pipeline Los Angeles hospitals. Overall, there's improving macroeconomic trends for hospitals. They're seeing strong and improving tenant rent coverage, as well as rapid balance sheet improvement, particularly for Steward, which really was the problem child for this business, so that has kind of resolved itself. Overall, it's looking like all its tenants are getting in a better financial position, not necessarily fantastic financial positions, but they're not really looking like they're in a situation where they're going to be unable to continue paying rent anytime soon. And as far as I'm concerned, all three of the key problems that MPT was being accused of, or that have been commonly cited by analysts, it looks like it's either solved them or is in the process of solving them. The final shadow on this business, and it's less so MPT directly, it's more the real estate investment trust industry, is that debt maturities need to be addressed coming forward, because we're in a really tough environment for these businesses, and this REIT in particular has some debt maturities that were coming up, so they've used some property sales to pay off some of these, or repayment for anticipated property sale. Cash reserves are paying off one of the term loans, full repayment of another expected from the sale of the Australian portfolio. They believe they're closing around $1.4 billion of binding dispositions and loan repayments, and this is going to repay all of the debt maturities. Roughly $1 billion of immediate liquidity as of the 31st of March. We'll get a better look in the next portfolio update, but they have $19.1 billion unencumbered asset base. Near-term investment spending is very highly selective. Generally good acquirers, in my opinion. They very rarely waste money. They have enough liquidity to continue going. That's a sixth of market cap right now. I'm quite happy with this business's debt position. They look like they're in a strong position to address the subsequent maturities. Relatively flexible balance sheet. I think this is a really strong update, and for me, most of the issues with this business are solved. The general operations of this business and the debt have been secured by some sales of their property portfolio, but if they want to continue paying the dividend, they just simply cannot stomach what they saw in the most recent quarterly update, which is March 31st. So we'll get a better picture in the July update, but let's just go from this for now. They saw rents down from 410 million to just 350 million, and they've seen significant net income loss. So earnings per common share 5 cents compared to $1.05 the year before. They just simply cannot keep up a 29 cents per share dividend when they're recording 5 cents of earnings. That is wholly unsustainable, and at this rate I can see the dividend coming down. Now, it's a pretty massive dividend at 12% yield. I think the stock price has a lot of potential appreciation value, but for me this is just not good enough, and we need to see this righting the ship soon. And I believe Medical Properties Trust will right this ship. I believe it has a quality portfolio, and it is definitely capable of righting this ship, because it is a very tough environment for REITs at the minute, and many of its properties were facing some dire straits in the early part of the year, but it looks like it's completely righted this. So for me, this is not a complete slam dunk, but I do agree with them that there has been unwarranted valuation decline. If the business performance carries on as it does, I think it's an absolute stinker and to stay away from it, but I believe they can right this ship. I believe that this is not by any means a business that deserves to be trading at these sort of valuations, and while I don't believe it will be able to continue paying its dividend yield with the current results, I still think the dividend isn't going to go to zero. It offers a healthy yield, and I think stock price appreciation will more than make up for it. just in the last few weeks, it's up 15% as the story really starts changing this business. I think really for this to be a strong investment, that's all that needs to happen, is the business to effectively manage sentiment and increase the sentiment with this business. I think they're already doing that. So for me, tentatively, I'm going to be adding a small position. I'm not so interested in the dividend yield, though it is really nice at 12%, because I don't think it's going to stick around for that long of a period unless they can right-size the results. But I think just sentiment changes is going to be enough to provide decent returns from here. Of course, that's just my opinion. You let me know what you think in the comments down below about MPW. I'm not a financial advisor, so you should not take this as financial advice. Do your own research and due diligence. Capital is always at risk, of course. Let me know what you think in the comments down below. Like and subscribe and enjoy the video. I'll see you again next time.